Manish Sonthalia joins us now. Let's take a conversation forward with him. Manish, good morning. Thank you for joining us. We are at an all-time high, plus minus 1% here or there. But frankly, there is no zing in the market. Nobody's feeling happy, excited. There's just no euphoria. Why is that?
I mean, I would want to believe that beyond a certain point in the markets, people were skeptical of the markets moving up higher. You have some decent cash levels sitting in the mutual funds, funds 5 to 10% thereabouts. FIIs probably are not yet begun buying in a big way. All of these factors may be contributing, but I clearly believe that there's a lot of upside left in the market, given the way how earnings have shaped up or likely to shape up in FY23. So there is an MO for fear of missing out, and that's keeping the markets quite buoyant.
Okay. Um, Everything has gone right for us. Crude, earnings, currency, uptick and robustness of the banking sector. So for markets to go higher, what could be the next trigger? Because if the triggers are not there, then markets perhaps may not go higher.
So I think the pillar of earnings growth for the Nifty per se is basically resting on four pillars. It's BFSI as a whole. You have technology, you have consumer, including autos, and you will have everything else, including industrials and capex related themes, which would be the rest of the pack. So I think as long as these four pillars keep on firing, there's enough ammunition on the table for the markets to move higher. So BFS, if you see the last quarter numbers per se, you have two sectors which were actually holding out quite well. And this is basically your banking pack as a whole and technology as a whole. Even though there has been some valuation correction, but earnings are held out for these two sectors. Rest of the pack basically was suffering from margin pressures. And of course, margin pressures are abating, given that commodity prices have come off, inflation is somewhat cooling, crude oil has come off. All of this would have a positive rub-off effect on margins going into the second half of this year and into the fiscal 2023. So from this point of view, I think these four pillars would likely leave the mantle of earnings growth, and that should keep the markets quite important.
In your portfolio. Now I can see there are a lot of banks there. Is there a conscious reason why you've changed it?
Sorry, couldn't get you.
No, there was a lot of, if I look at your old portfolios, they were dominated by two themes, uh, IT, banks, and autos. But I can see that bank is right up there and IT has really fallen down. Is there a conscious strategy to move out of IT?
No, not at all. In fact, we are equal weight, if not slightly overweight on IT as a whole, even though we have seen higher levels on IT stock and there has been some valuation correction. BFSI is right up there because we think that BFSI as a pack will lead from the front, whether it comes to NII growth, whether it comes to operating leverage playing out through cost advantage, whether you have clean balance sheets of banks leading to lower provisions, and all of this culminating into decent profit growth, both for the PSU banks as well as the private sector banks. So there's no question about banks per se as you move into FY23 and 24 as a whole. The economy is really firing on all cylinders and balance sheets have got cleaned up. That is rubbing off, on numbers banks. When it comes to IT, I would clearly believe that margins have bottomed out. There could be some volume slowdown as you move into FY23 and compare that FY22. But valuations also have come off. So I think anywhere between 1.5 PEG on IT as a whole would mean there is a case for decent investments in IT stocks because the journey is not yet over. It's a 5-year story going forward. And, there's a lot of top line that's likely to come in many of the recent IP names that we have. So that's the reason why we are equal weight, if not slightly overweight on IT as a whole. And as I think we move into the second half of fiscal 23, you should see again IT back. So, automobiles, in any case, we were quite overweight. We still are overweight. Of course, there is some slowdown post the festive season that's likely to play out. But again, margin pressures will come up, and pipeline and pent-up demand looks quite good.
Good morning, Manish. I remember that interview of yours, I think back in August, when you had said you're not going to see 15,000 on the Nifty again, that it is not a bear market rally. You're certainly sounding very, very optimistic and bullish as we go into the new year. Any predictions for what kind of levels we are likely to see for the Nifty in the new year?
Well, I think 20,000 on the Nifty is a given. Early next year, maybe the second half of next year. But we are clearly poised higher rather than lower. India is one of the largest economies, one of the very large economies, which is going to grow high single digits even in FY23. And there is a whole pall of gloom all over the world. And, institutional investors, particularly foreign institutional investors, which have been great sellers in the last 1 year, will come back to increase India allocation is my belief. And in any case, domestic have been buying all through, and this is not likely to slow down. So, where are you going to get the good stocks? The markets have held along so well when there has been so much of selling, when there is buying that's going to come from both the domestic as well as the foreign. There's not enough floating stock available in decent prices. That is only going to lead the markets high. So the markets have become extremely broad-based, and the journey is likely to continue.
So 20,000 for the Nifty is a given, says Manish Sonthalia. There's going to be a lot more buying. But do you think it'll be like 2020, where everything after the pandemic outbreak in the first crash, everything went up? Because we were still waiting for the momentum in the broader markets, and this even as the delta in valuations between the large caps and the broader markets is only getting smaller.
No, I would believe that large caps again have to lead the markets when it comes to moving higher, because the valuation gap between the large caps and mid caps have converged significantly. And if the markets were to hold, then obviously it has to be led by earnings. And earning 50% of earnings is led by basically your Nifty 50 or NSE 5 and BSE 30. So, it comes to earnings growth, I think the next round of rally is going to come from large caps, let's say. And this is going to be led by 4 major sectors. It's going to be technology, it's going to be industrials, it's going to be banks, and it's going to be consumer. There's going to be pick and choose between these 4 sectors, but that's how the things are looking like. From the next 2 to 3 year point of view, one focuses on these 4 sectors. I think broadly, they will be better than what the entire benchmark Nifty earnings will average over the next 2 3 years.
Right. Manish, since you're talking about what's going to outperform in the times to come, I wanted to understand, looking back and looking at how strong the PSU rally has been, including banks year to date, going by that, I don't see very many PSU names actually in some of the key portfolios that you hold.
Yeah, so actually, we have Container Corporation, we have included BEL, defense play. We had HPCL, we actually moved out of that. But I think in the PSUs, in the case of PSU, look, what is happening is that, because of the inflation and all of that surrounding the global market, there's a shift away from growth investing to value stocks. Obviously, PSUs fit the mantle quite well when it comes to value within the traditional definition of value. But, it remains to be seen how wealth is going to get created in the PSU pack as a whole. But right now, it is just a play on value as a whole. I think it makes sense to stay with monopolistic PSU stocks, when it comes to creating alpha. So we have a Container Corporation where there's a case of divestment in Delhi Mumbai corridor. On the DFC is also around the corner. More asset turns, more margins, more ROEs, or whether it comes to the defense play, the entire defense pack is basically the prerogative of the PSU space as a whole. And there's a lot of value because there's a lot of visible growth available in this space for the next many years to come, so to speak. But the rest of the pack is just a catch up on valuation because peers in the private sector are valued at X, and these PSU stocks are valued much lower than what are. It makes a case for a tactical trade, so to speak, and this has played out extremely well because the PSU space as a whole has really massively fired over the last 1 year or so. But I think one has to stick to one style, whether one is really value investor, or basically they are growth investor. Since we are basically growth investor, unless it's something, an outlier in the PSU space, we would like to basically stay away. So, whether it be a State Bank of India, which is the largest PSU bank, or monopolistic players like BEL or Container Corporation, we would like to not generalize the entire PSU and take a call on that.
Manish, where is it that you've had conviction in the last, 6 odd months to maybe add positions to your existing names?
Yeah, so the pharma pack as a whole has seen some decent correction, and of course, what has happened is that we have a very high base effect of the pandemic during fiscal 20 and fiscal 21 and fiscal 22, because a lot of buying has happened because of the pandemic. And if the pharma sector was to grow at, let's say, X percentage, let's say 15%, all of that has got actually preponed during fiscal 21 and 22. Now there is a reset of that base. And of course, at the margin, you have margin pressures and price erosion in the US. But, because there is a degrowth because of a high base effect of fiscal 21 and 22, we are seeing negative correction in stock prices and decent pharma names. So I think on an add up or, add to the allocation, I think pharma space as a whole from the next 2 to 3 year perspective, depending on where your priority lies and how the pharma pack, quality injectables play where valuations have come off, is a good, decent 15 to 20% upside when raw material prices actually come off. And, domestic demand in many cases is pretty strong. Even the November number, which we saw from the IPM, was very strong at around 17% growth for the IPM market as a whole. So, again, at 2022 P on many of these domestic pharma names or even quality injectables like Plant, we think there's decent upside from an investor point of view from the next 2 to 3 year perspective. Case makes a case for an add in sectors.
All right, Manish, appreciate your time. So glad you could join us.